things you're seeing that I know you,
well, it's
that
just,
you wanted to talk
you know,
about today.
people always, I mean, historically, people always say that the bond market dictates or sees things before everybody else, meaning the stock market, et cetera, right? So recently I've seen trends in the bond market that are beginning to, I guess, raise my eyebrows and say, what's going on, right? What is it telling us? And by that I mean, historically, for example, when the expectation is that the Fed is going to raise rates, they don't even have to do it. Most of the time, the bond market, all rates, meaning, you know, the 2-year, 3-year, 4-year, 10-year, 30-year bonds, they all start to go up in rates, right? So it kind of like, it preempts the fact that they're going to do this, right? And then typically, if you think that inflation is an issue and the Fed's going to come in and raise rates, then what happens is the short-term rates go up because they're going to raise rates, but long-term rates begin to come down, right? Because they say, if they're going to fight inflation, then long-term is not going to be an issue. Short-term, they're going to raise rates, so that's going to be an issue. But something's happened recently. So, and remember, the Fed already said that in starting November, they're going to reduce their taper. They're going to start tapering, meaning they're not going to buy as many bonds. We're buying $120 billion of bonds every single month. So they're going to buy less, right? They haven't done anything yet, but the bond market already reacted to that. So if you take a look at September, right, and even early October, every time the rates went up, they went up in tandem. And what I mean by that, in other words, if the 30-year went up by 10 basis points and the 2-year went up maybe by 1 or 2 basis points, it's never the same, right? But they go up at the same time, or they went down at the same time. Maybe not 100% of the time, but maybe like 90, 95% of the time. Since October 8th, it's been a complete reversal, right? All of a sudden, that correlation is now negative. In other words, the 2-year has been going down in rates, and the 30 has been going up in rates. So what is that telling us, right?
Which is the opposite of what we would expect, basically. From what
well, it's opposite of what we've been seeing, right? And it's opposite of what you expect in this. Well, it's not opposite of what you expect. Because if you really truly think that the Fed is going to begin to raise rates in 2022, then the short end of the curve, meaning 3 months, 6 months, 2-year, 3-year, are the ones that are going to go up, right? Because that's where they impact the most. So why are they going down? And I think the reason is that people are beginning to, or the markets are beginning to get a feeling that inflation is here to stay. And if it's here to stay for an extended period of time, and again, does that mean 6 months, 1 year, 3 years, 5 years? We don't really know, right? But the feeling is it's here for a longer period. In other words, this concept of transitory is going to be a long transitory period, right?
So, I mean, if the 10-year and the 30-year rates are going up, that's long-term thinking. That's not short-term thinking.
Exactly. So it's saying it's here, and two, what it's telling us, right? If the 2-year is starting to go down in yield, it's telling us that most people are now beginning to feel like the Fed is not going to lower rates next year, right? And why? If you think about it, we have a situation where the economy is still not going as well as we had expected coming into this year. The global economies aren't doing well. So we have all this inflation going on in our systems, which typically meant that economies were overheating, and therefore you had to begin to slow them down somehow, right? That's not the case here. And I think everybody, including the Fed, especially the market, says, no, that's not what's happening here.
There's no way this is overheating.
Exactly. So the feeling is the Fed's not going to raise rates next year. They may taper either way. We'll see in November how much they taper. They may taper either way, but the Fed is saying we can't raise rates in a situation where the economy is not doing well because we're going to choke off any recovery, and that's going to be worse, right? And two, you know and I know that the Fed is saying a little inflation, what's the big deal, right? In other words, we want inflation to be an average of 2%, 2.5% over longer periods of time. It's been so low that even if we're at 6% for a year, the average is good, right? In other words, for them, higher inflation means that their debt, right, is worth less. They're buying all this debt. They basically know that the U.S. government is producing all this debt. Therefore, that's good for the U.S. government, and that's good for the Fed. But it's not good for everybody else.